brief introduction. And thanks MTA for providing this wonderful platform to present and giving us the opportunity to talk about Elliott wave. Elliott wave is something which we are really passionate about. We do look at n number of charts and try to apply Elliott wave concepts on these charts and see what the market wants to tell us. This technique is an holistic approach which helps us to understand where the market is headed by just looking at the price. We don't have to look at anything else. None of the other indicators is necessary to be applied. But by simply looking at the price chart, we can derive a conclusion whether the reversal is imminent or we should be expecting some strong trending moves on the upside and many different things. So in this entire presentation, we'll be discussing about various techniques from starting from the basic of Elliott wave, and we will also be focusing on the advanced concepts of Elliott wave, which many Elliotticians might not be using, that is necessary in order to reduce the number of probable scenarios. So thanks again to MTA and thanks to Shane. I'll quickly start. We have only an hour for the presentation and I'll try to justify the time that everyone is spending here. Okay, so let's proceed further. About the presenter, Shane has given the introduction about myself. My name is Ashish Kyal and I'll skip on this slide as of now and we'll jump directly to the topics that we're looking at. We will be looking at all these parts of Elliott wave. I'll not be covering in much detail about the basic part, but I'll still brief on the basic because that is very much necessary in order to understand advanced concepts. I'll try to mix a few concepts from advanced Elliott wave along with the basic when I go through it. In case there are any questions, I'll be attending to those questions at the end of the presentation, as Shane said, and probably if there are any genuine doubts, I might address them at the same point of time. Okay, so the topics that we'll be covering is the basic pattern, extension, fifth wave truncation, the concept of alternation, then equality. Channeling is something which is very, very important from a Elliott wave perspective. It's one of the basic technical tools that many people know about, but probably does not use it extensively. So we'll be discussing on channeling path and price and time confirmation. I'll be applying about time concept along with Elliott wave, which probably the basic Elliott wave does not cover, which is a part of advanced Elliott wave. And then we'll be moving on to the correction part, and that will be the flow of the entire sessions today. Okay, let's quickly start with the history of Elliott wave. The name has been coming from the name of the person, R.N. Elliott, who invented this study in 1930s. He discovered that stock market moves in recurring patterns and those patterns are called as waves. If we can identify the waves, we could be able to understand how probably the markets are moving, what can be expected in the near future, what can be expected probably centuries down the line. So there is a misconception that people have. Technical analysis or Elliott wave can be applied probably on only small scale charts on 10 minutes, 60 minutes, or probably it can be applied only on arithmetic charts or logarithmic chart. It cannot be used for forecasting for decade down the line, but that is absolutely false. Elliott wave or technical analysis gives us the power to forecast what is going to happen probably 10 years down the line, 30 years, 50 years, or even century down the line. So that kind of forecasting ability is provided by Elliott wave. We'll be looking at the practical charts of gold since 1920s. We'll be looking at Dow Jones since 1920 onwards, and we'll be discussing about how can we forecast what is the future price action probably 10 years, 20 years, 40 years down the line from here. So we can apply this technique right from 10-minute charts to probably monthly, annual charts, right from 1920s to 2050 and any kind of year, something like that. So R.N. Elliott was the person who invented Elliott wave in 1930s. Then for probably a few decades, the study was lost and it was then reinvented by Robert Factor of Elliott Wave International. So all due credit to him. And Glenn Milley, who founded NeoWave, which is the advanced part of Elliott wave. So they have done some fantastic work of reinventing the theory and coming up with their own way of looking at impulse waves, corrective waves, and different waves within Elliott wave. So moving further from here, I'll be discussing what is the building block of Elliott wave. Fibonacci series is one of the most basic important concepts on which Elliott wave is based on. This is a series which everyone might have probably studied at least in school or came across the name Fibonacci. What it does is it simply adds 1 and 1, and what it is 2, if I add 2 and 1, I get 3, 3 and 2, 5, and so on, the series goes on. If I divide the later number by the next number, or for example, I divide 89 by 144, I'll end up getting 0.618, and if I divide 144 by 89, I'll end up getting 1.618. 1.618 is called as the golden ratio. This golden ratio is visible across the globe, across different times, across different monuments as well. For example, a basic example is probably pyramids, and I'll just show you on the next slide. You can see it on the pyramids, you can see it probably in the solar system. Right from solar system, you can see something in the DNA. If you measure the breadth, the height, and you divide it, what you end up getting is again a Fibonacci ratio. So if something like Fibonacci is there from DNA to solar system, this technique has to be present even in the markets, because market is something, freely traded markets are something where each of the individual participate and behave in a way which is predictable. That's why we use Fibonacci for retracements and projections to understand what should be the target, to understand what should be the stop loss, and that's why Fibonacci plays a very, very vital role in case of an Elliott wave. The next concept, which is very important before we start Elliott wave, is the concept of fractal nature. By fractal nature, I mean if something works on a small degree, has to work on a bigger degree. For example, when we look at basic patterns like triangle, we can see triangle patterns on a 10-minute chart, we can see triangle patterns on a 60-minute chart, and we can see triangle patterns probably weekly, annual charts as well. So if triangle works on 30-60-minute chart, it will definitely work even on the annual chart. So that is nothing but a fractal nature. And Elliott wave has two basic building blocks, fractal nature as well as Fibonacci, and based on these two concepts, the entire Elliott wave goes on. Let's now move ahead with the basic understanding of Elliott wave. There are two different parts to Elliott. One is the impulse pattern and one is the corrective pattern. We'll be discussing about impulse pattern during the probably for next 10 or 15 minutes, and then we'll move on to the corrective part. An impulse pattern is a basic 5-3-5 pattern. I'll explain that very clearly. In an impulse pattern, what happens is we have 5 waves in the direction of the main trend. By that I mean, if I draw this is wave 1, wave 2, I have wave 3, then wave 4, and this is known as wave 5. We label the waves at the end of it, so 1. So from 0 if I start, I have wave 1, I have wave 2, I have wave 3 here, then 4 and 5. Impulse waves are always labeled as 1, 2, 3, 4, 5, whereas corrective waves are always labeled as A, B and C. Impulse waves can be on the upside or downside. There are many misconceptions people have. People think that corrections can happen on down and trends can happen on up. That is absolutely wrong. Even trending moves can happen on the downside and corrective moves can happen on the upside. So there can be a possibility of impulse wave either traveling on the upside or traveling on the downside. The basic criteria is that it should be a 5 labeled as 1, 2, 3, 4, 5. There are now basic rules in order to mark anything as an impulse pattern. There are 3 basic rules for a pattern to be called as an impulse pattern. Let's see what are those 3 basic rules. The first rule says that wave 2 cannot retrace complete of wave 1, which means over here if you see on this chart, wave 2 cannot retrace complete of wave 1. So if if wave 2 goes beyond the start of wave 1, then this is not a valid impulse pattern. So I cannot label it as 2, I cannot label this as 1. So for it to be valid, I need to have wave 2 cannot retrace complete of wave 1. That's first basic rule. I will now combine up an advanced part of the rule which says that wave 2 in fact cannot retrace more than 61.8% of wave 1. To understand the concept of retracement, let me explain you very quickly. This is wave 1, this is wave 2, and then we have the next wave on the upside. Now this wave 1 and this is wave 2. This wave 2 cannot travel more than 61.8% retracement of wave 1. That's one of the rules. Then the next rule says that wave 3 cannot be the shortest of waves 1, 3 and 5. This is a very, very important rule, which means that wave 3, which is this wave over here, cannot be shortest of 1, 3 and 5, which means wave 3 can be shorter than one of the waves. That is, wave 3 can be shorter than wave 1 but has to be bigger than wave 5. So this is possible where wave 3 is shorter than 1 but bigger than 5, or wave 3 can be bigger than 1 but shorter than 5. Or wave 3 is, as shown in the chart here, wave 3 is the biggest of all the waves. This is rule number 2, which has to be followed. If it is shorter than both the waves, then my wave counts will not be valid as 1, 2, 3, 4, 5. Wave 4 cannot enter into territory of wave 1. By that I mean, let me just clear up the screen. Wave 4 cannot enter into territory of wave 1, which means that wave 4 over here cannot come down and enter into territory of wave 1. So if that happens, then my count of 1, 2, 3, 4 and 5 is not valid, because wave 4 over here has entered into 1, so I cannot mark it 4, I cannot mark it 5, and I cannot mark it 3. That is the reason. So these are the 3 basic rules which has to be followed in case I have to mark anything as an impulse wave. Also, one more thing that many Elliotticians seem to do is that, please understand, impulse wave is something which is seen probably only 20 or 30% of the time in the market. Rest all the time markets are moving in correction. So it is generally preferred to mark something as a corrective wave and not as an impulse wave. So if you have any doubts about impulse, stop marking it as an impulse and mark it as a corrective wave, and you will be probably 70% of the time correct. See, Elliott wave is again everything about probability. If you are 70% probable that a scenario is happening and 30% probable scenario might not happen, and you have a favorable risk reward on the chart, and so what happens, you will probably on a net basis, you will be right 70% of the time, wrong 30% of the time, and still you will make money. The main intention of Elliott wave is helping us in making money during when we trade. So if you are right 70% of the time, or rather if you are right even 60% of the time, and you have suitable risk reward if you trade options, that should be it. So there are times if you apply advanced concepts that we are discussing today, you can get an accuracy to the extent of 95%, but surely that comes with an experience. Even 95%, there are times when you are 98% sure this should be the scenario. But it takes time, it takes experience to do that. Let's move on further. These are the 3 basic rules. Let's now get into the other part of the wave theory, which is extension.